The market was going strong into the end of the year, and well, 2024 came and had something to say about it. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our first Elite webinar of 2024. Now, if you're watching the replay on YouTube, do me a favor and smash that like and subscribe button down there. Go ahead and click the bell icon right next to it to get notified every time we upload a new webinar or video here on the channel, because this year you're not going to want to miss a single one because it's probably going to be a wild ride. And Riz, I gotta say, you kind of called it here. You were calling for 4,700, and we just took a slide down this week in the S&P 500. We kind of topped out here right on the Thursday, or excuse me, Friday the 29th, and we just started to curl over, and that was it. We have sunk right back down to 2,700, and a lot of indecision these last 2 days, especially Thursday and Friday. Look at the wicks on those candles. All I gotta say, bro, is man, you called it.
Yeah, no, thanks. I'm happy with my projection there. I know the just the final, even the final session that we had, webinar of 2023, I was squarely leading bearish. I am bearish. Like some of our bearish plays is paid off. I was short, nothing extraordinary, just something small, in terms of SPX futures shorts. Now with Thursdays and Fridays price action, I was like, well, especially Friday afternoon, I'm like, all right, I'm gonna take this off. Took some profit, and I did it just in time for like a late rally that little occurred. Eventually, the market did open higher. Sorry, close higher than it opened, hence that green candle. Um, so I'm glad I took that off, but still I am relatively bearish when it comes to the medium term for 2024. I'm not saying that it's going to be a straight leg down, and we've touched on this before. I kind of feel like, okay, maybe we see a little bit of dip buying. We did see that heading into the new year, the RSI on the S&P 500, the index here also went down back into kind of like the middle area, not quite, but getting there. So not overbought anymore. Okay. And that's clearly because of this kind of back-to-back type of red days, and pullback that we saw, which isn't much of a pullback, is still relatively small. But I feel like I think this is healthy. This is good. I'm not, I would say, uh as conclusive on if we will see the 4,600 level anytime soon just yet. So I can't make that kind of call. We do know that's a potential support area with late July rally kind of being being the top area in July of last year. So we do need to keep an eye on that level 4,600 level. But right now we're obviously closer to 4,700, closed down just below 47. So I'm not going to be drawing it to too many conclusions. We did have a shorter week as well. Volume and participation really comes in to the market starting this coming week onwards. So it will be interesting to see if we do get a little bit of a dip buying at that point. If we do, I might consider potential re-entry into some short bias trades.
Yeah, I mean, that makes some sense. Obviously, we have this big sell-off. Some people are going to buy the dip, of course, and we're seeing that, but there's still a lot of downward pressure. But just be aware, we are still in an uptrend. Even with this full week of selling, basically, we are still in a nice, solid uptrend right now. There's definitely some support here. We'll see if that line holds true. Eventually, it probably will break, but for the moment, we are still holding above that trend line. So, like Riz was talking about, it's not time to just, throw everything short. Short everything. We're not in that territory yet, and it's one of those things. We never make a straight leg up or a straight leg down for the most
Yep.
part. It's always sequential. There's periods of up, there's periods of down, and I don't expect that that's going to change anytime soon. And that's really where the real traders make their money at, and that's kind of what we're trying to accomplish here.
Absolutely. I love how you said that. And especially with your line, your trend line there comes in handy quite a bit here. And this time is no different with that really, really getting close to it. Let's see if, like you said, maybe we do get a break below. That will be definitely a bearish break below if we do see this continuation lower. who knows? Maybe we get access a little bit of a support that we've seen before with some of your trend lines, with followed by an eventual break. But remember that 4,800 area is a strong, strong resistance on the daily. And I'm pretty sure even on the weekly, right, when you go back to 2022, 2021, started 2021, that 41, sorry, yeah, it started 2022, that 4,800 area, it remains to be elusive, right, and a strong resistance. So, 2 years on, that's where we kind of are, if you think about it. So I always look at it this way. Um, for all the passive investors, passive investing is fine, but imagine buying the index S&P 500 ETF 2 years ago, all right, 2 years ago on the dot, and you're now finally at around break even. So I love how, especially in the personal finance space, I see it a lot, and I'm not gonna call it any names, but if I invest every, 5,000 by every year, by 30, 20 years, I'm gonna be an automatic millionaire. Yeah, that everyone does that, and I get it. The market is, provides 8% annualized return, but that's over a 30-year span. And that's assuming if previous historical rate environment, risk environment, economic environment stays the same. We are no longer in that world, right? So for all these people who don't who think the last 20 years are exactly how the next 20 years are going to be in terms of an annualized rate of return, I genuinely believe they are going to fall short of their millionaire target goals of just passive investing. Don't get me wrong, I'm not ragging on passive investing, but passive investing the last 20, 30 years, uh, was different. It's different now. It's still viable, but people need to check their expectation. Where if you think 8 to 10% annualized is going to continue to chug along, nah, we're going to see more. We're going to see more volatility. We're going to see higher risk adjusted premiums. Like you need to have needs to be more worthwhile in the market for people to actually invest. The companies need to provide more profit because the risk-free rate of return is higher. There's other alternatives. So back in the day, the last 10 years, 15 years, even since 2008, um, rates have been extremely low, unsustainably low. And the fact that it lasted that long juiced markets, juiced returns. Are we seeing that anytime soon? I don't think so. We know that we're now in a new world where we're in a rate environment that is not sustainable to have 2% benchmark rates or 1% benchmark rates. We know that's not sustainable. And I wouldn't be surprised if, for the next few years and longer, even next decade, we're seeing 3%, 4% benchmark rates in that ballpark. That's quite a bit different than a percent and a half to 2%.
Yeah, I think that's a classic trap that people get stuck in. They think that everything is always going to remain the same. It's always going to do exactly what it's done before. And you get caught in that, well, back in my days, Sonny, all we had to do was put money in the stock market and we're millionaires. It's just not that way anymore. You have to be more active in the market. You have to be more aware of what's going on because, like what Riz was talking about, if you just invested in the S&P 500 when it was at all-time highs, you haven't even gotten back to break even. You're close, but you ain't there yet. So let's take a look here. Speaking of the S&P 500, take a look how things are going now. If I put this on year to date, it's going to be kind of a hot mess because we've only had a few trading days to kind of look at things. But I'll pull it back to the other view here in a second. But as you can see, not too much to talk about. We're down about less than 1% on the S&P 500 so far this year. But yeah, let's go back here. Let's at least give ourselves. Ooh, that ain't the right view. Sorry about that. There we go. That's what I want. So I mean, looking here at the past, couple days after, we closed out the year, tech and communications and consumer discretionary taking a big hit, and we are talking about this, going in with these sectors being so inflated that if the market goes, it's going to bring these with it. And lo and behold, that's exactly what happened. So we've seen a very nice dip here in tech, and that seems to be kind of the biggest loser from the sell-off for the most part. The other, sectors really not suffering so much.
Yeah, we see uh them being more resilient. Obviously, they were the underperformers the past year, so they've held up decently with the brunt of the damage being in tech. and even XLY, which is the consumer discretionary, right? Communications kind of held up a little bit because we've seen things like Google and App kind of stay up, but Apple was the big drop. Apple was the big deciding factor in the drop in the market. And I assure you, with the largest market cap, it was putting that downward pressure. And interestingly so, broke below that 50-day moving average, right at that 200-day moving average support, as well as the RSI kind of just touching just at the oversold level. So it's funny because, Chris, I mentioned Apple on Friday, but I decided not to take it. I'm glad I
Yep.
didn't because it did go lower on Friday from the opening price. So I can't say what we're going to do at the start of the week. That's going to be for elite members, but it's going to be interesting as we see Apple kind of finally pull back a bit. It was one of the tech darlings for all of last year. Massive, massive performance. And then we're gonna have to see, when the shoe drops, or does it drop for the other big ones? Microsoft. Do we see this happen for Amazon? Do we see it happen with Google/Alphabet? Do we see Meta, which had a tremendous, tremendous year last year, eventually kind of pull back and kind of retrace because it's done significantly well. I think last year it did like 100 and something% uh, gain, I
Easy.
think. Yeah, in performance. So very, very different scenario. Oh, look at that, 168% for, such a big company. That's huge. That's a huge, huge uh recovery from where it was when in 2022 it was like Facebook's over, like it's going bankrupt or something. Remember back in the day,
Yep.
it was like, yeah, it's game over, guys. $80, $90, and then here we are, like from the lows, Chris, from November 2022 lows,
Yep.
to
Yep.
now. That's probably like even, what is it, 400%, 300%? Yep,
300. Yep.
300%. That's wow, you know.
Nuts.
So that's why there's power in being active, or I would say strategic in your investments. If you would have held from 2022. You started at the start of 2022 and you'd be not even break even. Whereas if you were strategic, you pick some companies to get in and out of. Again, I'm not saying day trading. I'm saying strategically swing trading, position
Yep.
trading. Uh, that's where the outsized returns have been, and I think that's going to continue. If you have a process, you have a discipline, you have the right training and the right guidance, uh, the ability to outperform the market significantly and do so at the same time while decreasing your risk is very much so possible now more than ever because I think we're going to continue to see more volatility. 2022 onwards, we saw a lot of volatility. It's been a little bit less volatile, obviously, in the last quarter of 2023, with kind of the market just kind of dragging higher. But I think this year is going to be that year where we see that volatility come back, and we've kind of seen that uh, from the beginning of the year to now.
Absolutely. No, it has been definitely a bit more volatility to say the least. So let's go ahead and take a look here. If I can get that, there we go. Get that to move. Let's take a look here at oil and gold, our first two asset classes that we'll discuss. And, oil is still just kind of languishing down here in the 70s. Just can't break out of this, this channel here that we're in. Right around, about 69 to about 76 is really where we're stuck at. Now, of course, we were higher earlier, but we've come right back down into it since about the end of November. We have been just stuck below this support and resistance line here at 76, and we just can't bust through it. Gold, however, decided to make a run towards the end of last year, then sold off, looks like rather quickly, to be honest with you, and has come back down right around this $2,050 per ounce area. Yeah, Riz. I mean, everybody's calling for $100 per barrel oil, and of course, we all know that that's really not sustainable. But yeah, if they're calling for it, they ain't getting it because oil is just stuck down here.
Yeah, and in fact, I would say at this point, uh, a lot of the momentum in oil prices have kind of died down. A lot of the euphoria in prices, like you said, going 100, 120, that kind of narrative has definitely died down. In fact, a quick stat for people watching this live or in the recording, the hedge funds in aggregate are the least long they have been in the last 5 years, least long on oil. So what does that mean in English? um, the amount of long positions in oil are at the smallest that they've been in the last 5 years. So if you go back, to 2019, uh, that's the last time hedge funds were um, long at the current level. So I don't see there being a lot of bullish bets in oil from the hedge fund side. So we know the institutions will definitely impact the market. So we haven't seen that on the bullish side, but that doesn't mean they're short, right? They're just net long. It's very, very minimal, and it's been so the last 5 years. It's at that level. So it's 5 year low in terms of net longs. But to clarify, that doesn't mean they're outright short, right? So something interesting to see because we see oil languishing, kind of moving sideways in this channel, uh, for the better part of all of last year. Uh, and that can be one of the reasons why we don't see this massive push or direction is because institutions aren't leaning to one side too much, whether it's bullish or bearish.
That makes a lot of sense, given everything that's going on. Let's take a look here at the bond yields. And, we had quite the downwards, spiral, for lack of a better term, in bond yields from about the middle of October, really looking bearish. But it looks like with, the market rolling over this week, bond yields have started to perk back up a little bit, maybe have found a floor there. And of course, we were talking about, pricing in rate cuts this year. We'll see whether that happens or not. But the dollar seemed to have found a floor as well, right here around this 100 area. Nice little rebound there on the US dollar. So dollar's still looking quite alive and well. And bond rates looks like they may be recovering a little bit.
Yeah, it's interesting how you see the correlation, the positive correlation between bond yields and the US dollar, right? I've said that before, where you see that downward slope from October onwards in yields, and then you see that same downward slope October onwards in the US dollar index, right? So the strength of the US dollar compared to other major currencies. And then same thing, start of the year onward, you see a little bit of a pickup in the US dollar, and then same with bond yields, right? So very strong positive correlation there. I've mentioned that to keep an eye. Once we do see that eventual rate cut that the market is expecting, whether it's, there's some expectations of March, there's some expectations of June. We'll see as we get closer to these months, because as we know, the market can completely be off track and completely amiss of what's to come. We've seen that last year. So it'll be interesting to see when things start getting priced in versus out from a rate cut standpoint. But when we do see that eventual rate cut, I'm sure we will see one, whether it's 25 basis point or whatever, that will obviously drop bond yield. Yields will go down. Um, and then don't be surprised if you see a little bit of a weakening in the US dollar as well.
Definitely something to watch out for. I think March is a little early, if you ask me, but who knows? The Fed may want to get things started early this year. Now, for everybody here on our live webinar, if you have questions for Riz or myself, now is the time to go ahead and start putting those in chat while we take a look at the important dates for the market this week. And there really is only one, and it's Thursday, and that is the core inflation rate month on month and year on year. That's going to be a big one, as well as the inflation rate in general. Both of these are going to be huge catalysts this week, potentially either direction. Now, if the numbers come in hotter than expected, that's not good, and people will probably view that as a negative catalyst because that means that maybe rate cuts won't be coming, and everybody wants to price in those rate cuts. But if it comes in better than expected, that definitely could prop the market up. Riz, are you thinking about doing anything fun and exciting for core inflation announcement day, or are we just going to be sit and watch?
So you're absolutely right in terms of how that could play out. So that's good. I'm glad you shared that. But from a trade standpoint, positioning standpoint, uh, I feel like a lot of the major moves have been done in terms of trying to bet on inflation, uh, the catalyst here and there. So yeah, there will be some volatility that day, no matter what. But and I think Chris, I think it's supposed to be at 8:30, right? I swear it's at 8:30 in the morning.
It probably is. I
9:30.
probably have my time in here incorrect, so
That's
I
probably why.
apologize for that.
No worries.
Yeah,
Okay. That's
should be
good.
8:30.
So 8:30. So I feel like 8:30 in the morning, we see the numbers come in. It's gonna move, pre-market regardless. But from a positioning standpoint, I haven't decided. I feel like I don't want to solely be taking a short bet or as a hedge because of inflation. I feel like if I see something in the market structure from a technical standpoint, then yes, maybe. But as of now, I can say, openly, as elite members know, I'm about like what, 91, 92% cash or something like that. So that's actually the largest cash position I've been in, I think, in the last year.
Oh yeah, oh yeah,
A
for
year.
sure.
So usually it's 70, 60 something, 75, but 91, 92% or something. I can assure you that's quite high for me too. So I am looking to see if there's some opportunities that are worth taking to buy to go long on. But I'm not going to rush. As I've said, I'd like to see markets get to a level where I feel like, okay, I'm comfortable. There's some baked in margin of safety. There's some good values, based stocks, and they're insulated. And we'll see. But right now, only two core positions that I have open from a long standpoint. And the rest is all cash.
There you have it. And if you notice here, the forecast and the consensus are pretty much better than what was reported previously for the most part. So we'll have to see if those numbers hold true. Now, Jeff went ahead and posted a question. He wants us to take a look at Save. Let me just pull this up. Oh, Spirit Airlines. I know this one. So he's been selling puts around the $10 to $11 strike to collect premium. Nice. Volatility is currently juiced. Great use of words there due to a DOJ lawsuit versus JetBlue and Spirit merging. Would like to hear our thoughts on risk associated with it. Well, yeah, it looks like they took quite the beating here. I'm assuming that has to do with this lawsuit and a nice bit of a recovery here since about mid-November, it looks like, on Spirit Airlines. I know, Riz, typically this isn't something that you would trade, but what are your thoughts on this strategy?
Yeah, so the short puts around the $10 area, 10, 11 area is actually pretty good. Volatility is a little bit up. Again, nothing crazy. I know it's probably high on this specific contract because of the DOJ lawsuit and the potential impact on the merge. But yeah, I think that's a fair play. I think that's definitely a fair play. I feel like I wouldn't go long or short at this standpoint, especially in between the mergers. So it's not surprising if they're going to consolidate a little bit. But the moment the catalyst comes out, based on what the DOJ, uh, if the two companies decide to continue to pursue this merger, maybe they call it off. We've seen that when there are some regulatory hurdles and pushback, whether it's the DOJ, wherever, FTC, anyone, some companies will just say, all right, scrap this whole thing. And then there's maybe a charge off, meaning a cost associated with the legal stuff. And then they take that hit and then that's it. We could see that happening, right? So something to be mindful of, but I think that $10, $11 mark area for Spirit Airlines is safe. So I think you could continue to do this maybe a week, 2 weeks out until maybe the volatility dries out or just doesn't make any sense anymore.
Absolutely. Once that catalyst comes out, you should expect a lot of movement either direction. And that could be, and this is, guys, if you want to ever ask a question, look at these last two questions. These are spectacular. Manuel says he's got a couple of super boring stocks that I want to pick your brains over. Sounds awesome. First off, we're going to start with BZ, which is, yeah, Verizon. That's what I thought. So would Verizon benefit from the Walgreens dividend cut and now being the largest Dow dividend paying stock? Would we potentially see an increase in positions? That's an interesting concept. If Walgreens is cutting their dividends, does that mean that more people are going to flow into Verizon? What do you think on that one, Riz?
Very interesting. Very interesting. Essentially like a rotation into uh, uh Verizon from Walgreens. I feel like yes, that's possible. Is it going to be a material difference solely because of Walgreens cutting the dividends? Not necessarily. I would say Verizon has done really good. Obviously, they've been a solid dividend payer. They're a telecom, so very different to something like Walgreens, right? Very different industry. So I feel like would it benefit much? I don't think it would be negligible, even if it did. Um, but this is still a decent stock to hold. Obviously, from a dividend standpoint, I'm not too big a fan of holding communication stocks, you know, whether Canadian or American. But it definitely is a viable strategy to be able to hold, especially for the medium to long term, decent telecoms, decent dividend paying stocks. And Verizon is definitely one of them. It's definitely come down over the years. So underperformed from a capital gains or growth standpoint. But of course, that drop is offset a little bit by dividends, right? I feel like if you're gonna buy a company, never buy it for the dividend. Buy it because it's a good opportunity, a good company. And I'm not saying you're not, Manuel. I'm just giving an example to everyone else, because you need to kind of turn that over. A lot of people say, "What's a good dividend stock?" I say you don't buy a stock just for the dividend, because if you buy it for that reason only, more often than not, you're gonna underperform from a growth standpoint. It can happen where they grow solidly plus continue to pay a dividend, but very rarely can you have your cake and eat it too in life. And this is one of those scenarios. And I feel like this applies to every stock, but primarily these solid, large cap companies that are no longer growth stocks.
Absolutely. Now, the other two we're going to take a look at here, and he's wanting more of a medium-term perspective. So TRP, TC Energy Corporation, that one I don't know a lot about off the top of my head, but I suspect Riz does. So his thesis on this, he's mentioning it due to looking at sectors that could benefit this year since tech has very been overdone, and healthcare utilities might be the ones to outperform in 2024. So we're doing a little speculation here. We kind of talked about this at the about the middle of our last webinar, where often you see these certain sectors will overperform and then the next year doesn't necessarily pan out that way. We were talking about energy last year, I should say in 2022, excuse me, really didn't do so hot in 2023, whereas tech did great. So this one, TRP, obviously an energy stock. Riz, what are your thoughts on this for a medium term hold?
Yeah, and this is a great company. We've traded it before. We've held it before. We've swing traded it. I've held it for long term as well in my portfolio. It's a good, decent dividend payer. It's a large pipeline company. Definitely okay with holding, and it's also had a nice run up from the October lows, right? So, depending on your entry, I'm not sure when you got in or not, but it's definitely okay to hold. This is something I've traded before. We've done swing trades on it. We've even held it for, a few months time, and gotten out eventually. But I don't know your specific entry price, but nonetheless, it's a good stock. Same with your next mention, J&J is a good stock as well. We had a position, we did close it out for a small profit. Primarily because we held it for a long term. We gave it enough time. We also collected a dividend or two as well, so I'm okay taking it off. So factoring in the dividends, yeah, it was a profitable trade as well, or even more so profitable. But if you have a medium to long-term view on these, you can't go wrong, but I feel like you have to factor in opportunity cost. What is the style you want to gravitate towards? Do you want to be more strategic? Do you want to be more active? If you feel like you want to be a little bit hands off, if you feel like you want to have a portion of your portfolio, or there's a separate account that you want to have maybe more hands off, more long term, then these are the kind of companies that, yes, you can continue to hold, whether it's the Verizons, whether it's the J&J and TRPs. If you want to be a little bit more active, then I would see where you are at. Are you making money? Are you not? Are you willing to wait? And then from there, I would make that decision. But by no means are these not good companies. It's not that. They're actually great. You just have to make sure it aligns with your style and the intent of the account, right? So if someone has a registered account, so for those of you that are in the US, if it's like an IRA or a Roth IRA, and for those of you in Canada, maybe it's a TFSA or an RRSP, these are the kind of stocks that are good for that, because you don't want to be actively trading. You can, but it's not really recommended to actively trade in those kinds of registered tax efficient accounts. Also because you can't do certain strategies, like you can't use margin. Even the options trades that you can place, if you can, in those accounts, depending on your account options clearance, you're limited in the types of option trades you can place. You're limited in because it's a cash account, the trades have to clear. It could be 2 days, 2 business days. So you're kind of, hamstrung a bit with what you can do in these accounts. So I always say use these accounts for more of a long-term perspective, solid companies. Um, you can mix it up a bit, but for the more active trading side, there might be times where we've traded J&J. There might be times where we trade TRP and all that. Uh, but the intent is not to collect dividend. The intent is not to just buy and hold for years.
Definitely a little bit of trading advice there for you. So from a technical aspect here on J&J, having a bit of a problem with this 162 area, but still holding up pretty nicely over the 200 moving average at this point, even though we are approaching overbought on this stock. So just be aware of that if you're looking to get in right now. All right, Nikhil wants us to give our opinions on shorting DHI at current levels. Let's take a look. Dr. Horton, or DR
Yeah.
Horton, excuse me.
Yeah. So I think this is a construction company, if I'm not mistaken. Um, don't quote me on it. Actually, Chris, if you can expand the right side, yeah, let's see. Home building. Yeah, there you go.
Yep.
There you go. Home construction company. So yeah, there's quite a few home building stocks I've noticed, and I feel like this could be an opportunity where maybe they revert to the mean, right? So this is actually definitely from a technical standpoint, Nickel, you're absolutely right. This is a clear cut short from a technical standpoint. Um, the only thing is, well, we know that the entire sector, so all of home building stocks have done really well. They've been very strong. They've been strong performers. Uh, sorry, I shouldn't say sector, but the industry, the home building industry stocks have done really well. And this is just one of them. So in isolation, and even from an industry standpoint, yeah, a lot of them are overbought, a lot of them are overextended, and they're very much a clear short. From a fundamental standpoint, you have to be careful. You have to look, because a lot of these companies um, have done well. We know that there's a shortage in supply in terms of housing. So we know a lot of North America, and this applies to US and Canada, of course, and maybe even many parts of Europe, where there's a shortage of new construction. So these home builders their margins are really good. Over the past year, maybe their margins are a bit less because there's higher capital costs. Interest rates are higher. But other than that, they know that what they're providing and what they're building is in high demand, right? So, and the markets factored that in, and you can see they've also outperformed and beat earnings estimates, and their estimates have continued to go up. Analysts remain bullish. So, from the fundamental standpoint, they can be justified in some way that yeah, they've run up, they've done well. From a technical standpoint, yeah, I would not be able to fault anyone for thinking that this is a classical short. Just look at how overextended it's been, right? So if you do want to take a short, you have my blessing. Just make sure you operate in such a way for this. I never like to box people in. Even in my own trades, I don't like to be so rigid. But if you take a short, let's say at 148.63, it opens up on Monday, let's say, maybe have a stop around 152, and then maybe have a profit target around, I don't know, 140. 140, even 142, for a decent risk reward. Not the best, but decent. Again, that's very conservative. I could easily say, okay, aim for 140 or 136. That's very aggressive. But for starters, at least have a little bit of a stop. Keep it mechanical. With these kinds of trades, if they go your way, they do really well. If they don't, you're out for a little bit of a hit. Bingo bongo, you're done.
No, I think that's a great strategy. And yeah, it's one of those things where, yeah, single family homes right now are ridiculously high demand. And it is definitely difficult to get your hands on one, especially if you are, fresh out of college or, just starting your family. It's definitely tricky right now here in North America to get your hands on those. So yeah, just be real careful with this one. I like Riz's mechanical approach to this. Have that that stop ready to go just in case. I wouldn't recommend necessarily just setting the order out there for a stop, but keep an eye on it as you should with most shorts,
Yeah,
and
yeah,
you
yeah.
should do
Good
do
point.
just
Good
fine.
point. Doesn't need to be a hard stop. Remember, having a
Yep.
stop, I don't use hard stops. I don't have to have an order sitting there, good till canceled order sitting there in the book. I don't need to do that.
Yep.
Because again, I can operate in more actively and monitor it. But for some of you that, based on schedule constraints, timing constraints, maybe it makes sense for you to at least have it so you're not sweating it out. That if it does hit, at least you're out. But ideally, if you can devote the time, you can devote a little bit of screen time and watch it. I always recommend having mental stops so long as you have the discipline as well to be able to follow through on it. That way you're not kind of going along for the ride if this thing touches your stop and then comes back down, which we've seen happen.
Oh, dude, every time. I swear, every time back in the day when I was day trading, you put the stop on there, the stock goes right there, it touches it, and then it does exactly what you want. So just be very careful if you do use an actual hard stop, good to cancel order. because that can happen. Not saying that it will, but it's definitely something that does seem to like to happen a lot. And if you didn't have that stop on there and you were disciplined, like Riz was talking about, it just came up, touched it, and then rejected, you would be just fine. So yeah, it really looks like a good spot for a potential short from a technical standpoint, to say the least. All right. Well, I'm not seeing any other questions. Riz, what are your thoughts for this week? You're talking about this week we should see more volume in the market, obviously with people coming back in. What should people be looking out for this week as we go into our second trading week of the year?
Yeah, big thing will be to see if we can hold the 4,700 area. I know we're slightly below it, but for me, this is as good as being at it, the 4,700 area. So I can't come out and say like, yeah, it's broken below. I wouldn't count this as that yet. I feel like if we cannot get past the 4,700, if the market cannot get back up, I would say with some haste, that will give me a little bit more, I would say, conviction in a short. So that's my take on the broader market. From an opportunity from a stock side, uh, I'll leave that for elite members when I decide. But I do see a few opportunities present, but not as many as I'd like. Right. Hence why I haven't bought uh, you know any companies in the last week or even two. Kind of holding off because I'd like to see some more opportunities. Apple is definitely one that's presenting itself to be good, but because a lot of these companies moved up so much so fast, I feel like it needs to drop even more, or they need to drop even more for me to be, you know, salivating at the mouth. Like I'm a little bit more traditional in that sense where I need a better uh margin of safety. And I don't know why I use the word traditional because I don't know, maybe old school or I don't know what it is. Maybe I'm just more boring. Whereas someone else could be like, Apple at this level, fuck yeah, I'm getting in. It's dropped all of last week, and where I'll be like, nah, bro, like we needed to go a little bit lower, and they'd be like, oh, you're crazy. This is a great buying opportunity. I don't know, right? That's the beauty of markets and trading as a whole, where your interpretation and what's oversold or like not oversold, but what's a good value or what's a good entry point might vary. Uh, actually will likely vary from person to person. And that's the beauty of it, right? Obviously, there's people that are very far off the mark, but roughly speaking, there is that little adjustment, right? Like someone would be like, 4,700 has been broken. It's open to interpretation because technically it is slightly below 4,700. I feel like I look for a little bit more drop. I look for the candle as well. Um, just to give that example for people that there's a little bit of variability.
It's like the Drake meme, isn't it? With the whole Apple thing. I'm gonna have to make that the thumbnail for the video, guys. That's gonna be hilarious. Uh, but yeah, that was a good one. It's like, yeah, Apple at these levels, heck yeah. Riz like, no, hang on. Awesome. Well, hey, thank you everybody for coming out. Really appreciate it. You guys were awesome. Amazing questions as always. I know, Riz, you're talking about opening up membership here fairly soon. If somebody
Ah,
wanted to
yes.
get in, what do they need to do?
Yes, so there should be a link automatically in the description of the video. It should automatically be there. They can just click on it. It'll be a wait list, and they just join the wait list. And then they're gonna get an email when we do open. So for this opening, the first opening of 2024, is solely for the wait list, the people on the wait list. And when we open the doors on January 16th, everyone that's on the wait list will get an email and their slot is guaranteed. So that's how we're doing it for this opening. But yeah, it's super simple. It takes 2 seconds. Just click the link, join up. If not, or you have any trouble with it, or you have any questions, my email is in there too in the description. Everything you need to get in touch with me directly is all included as well.
Perfect. So if you're not on that wait list, make sure you do. As always, make sure you drop us a like, hit a comment, or hit the subscribe button on your way out the door, and we'll see you in the market on Monday.